So one of the questions we get a lot is, how do we access the cash value inside these policies? Well, we take policy loans, and there's a couple of different ways that you can do a policy loan. Just about every IUL on the market has either a standard loan or an index loan. So let's cover standard loans first. And the best way to cover this is to think about it from this example. Let's say we have $100,000 of cash value, and we want to take a $10,000 loan. So you call the company deposited that money into your checking account, and now you basically have $90,000 of net cash value, and you have a $10,000 loan. What the company's going to do is they're going to take that $90,000 unloaned value, and that money is going to stay in that index account going after that 10% cap. But the $10,000 loan that you have taken has now been basically set over here to the side, and the company is going to credit that $10,000 at a guaranteed interest rate of 2%. Okay, so that money is now moved away from the indexed accounts, and it's sitting over here with a standard loan being credited at 2%. Now, the government does tell us that if we take loans, we also have to charge ourselves interest. So what Mutual of Omaha is going to do is they're going to charge a 4% interest rate in the first 10 years, 9 years of the policy, and then 2% after. So with most of our clients, they're taking loans after 10 years because they've had these policies for a while. They're going to be seeing a loan interest rate of 2%. So basically, this is your true loan wash inside of an index universal life policy. You're being credited 2%, you're being charged 2%, really isn't hurting you at all to take this loan. Okay, so that's a standard loan. Now let's move and look at index loans. Index loans have become very popular, and they've also become a little bit controversial in this industry, so you have to be careful in the way some companies illustrate index loans. But what an index loan does is, let's go back to our same example. We have $100,000 of cash value. We want to take a $10,000 loan. With a standard loan, they moved that loan out of the indexed accounts and credited a guaranteed 2%. With an index loan, even that $10,000 loan value is going to stay in the indexed accounts and go after that 10% cap. Now, in order to go after those larger returns, the company is going to charge you more from an interest rate to do that. But it's not a terrible rate. It's at 4%. Currently at 4%, with Mutual of Omaha, it's guaranteed at 6%. So let's say that we do this scenario. We take an index loan, we leave that loan value inside the indexed accounts, and you cap out at 10%. So you paid a 4% loan interest rate, but even your loan value made a net of 6%. So you can see where index loans could be very attractive to putting even your loan value to work for you at a higher rate of return, as long as you realize that in the years where you have a 0 and you hit the floor, all of your loan value did not return any crediting for you, and you actually had to pay 4%. So it's very important when you take loans that you know how these loans work, that you know that if an agent's just sending you an illustration with index loans and not explaining index loan, you really need to make sure you're working with companies like us here at Insurance and Estates, where I go through and explain this chart to you and make sure you understand how index loans work. Okay. So let's put all of this into practice. What did it look like for this client? Well, for this client, what we decided to do was 20 years of premium. So from ages basically 36 through 56, this client plans to put in $240,000. Then we're going to let that policy sit there and continue to grow. And hopefully, based on a 6% average rate of return, it could be higher, it could be lower, obviously with a 10% cap. But based on an average of 6% over the life of the policy, this client is going to decide to start taking income at age 65 of $54,578 and continue that all the way through ages 84. So 20 years of premiums in, 20 years of income out, and this looks to be very, very beneficial for this client. So this client was a lot of fun to work with. He understood it. He really liked the idea of moving from the taxable world to the tax-free world. And once we covered the two main mechanics of an IUL, how does my money grow? How do I get money out of the policy? He was very pleased with what we had to offer. So guys, I can't stress to you enough how important it is to work with people that know how to design these policies correctly, that's going to take the time and the effort to explain these basic mechanics to you on the front end, so there's no questions or surprises on the back end.